In this video, I will show you the simple strategy that outperforms the market. I've been using this method to find successful stocks, and I believe if you use correctly this strategy for the long term, you will have great results. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 24% per year, thanks to this strategy. So copy it because it's quite simple and it works. Okay, now that you know the context, we are going to talk about companies that do buybacks regularly for decades. What are buybacks? These are share repurchases. So companies, when they use their excess cash, they can either reinvest in their own business, so like grow their revenue, etc., grow the profits. They can also give you dividends as shareholders. They can also reduce debt. If they have some debt, they can use the excess cash to pay some debt. And the fourth option, I think it's very interesting, is buybacks, share repurchases. You use your excess cash to buy your own shares. So it can create a lot of value if you buy them at a cheap price. So yeah, that's it. You know what the stock market is about: supply and demand. You have a certain amount of number of stocks and you have buyers. And the more buyers you have, the more demand for the stocks. So the stocks go up. That's very simple. So if you are a company and you don't have any debt to pay off, if you don't have good reinvestment opportunities, so it's worthless to reinvest in your business, if you don't want to pay dividends, because you don't want your investors to pay some taxes, you can buy your own shares. Add demand, add buying pressure. So, and if you buy back your own share at a discount, at a cheap valuation, when the stock price crashes, you buy when it's cheap, when the stock price is low, it creates a lot of value. You can buy a lot of shares. There are some companies that buy 5% of their shares every year. 10% of the total amount of shares every year. And as they do this for years and years, for decades and decades, you reduce the total number of shares. And I have here some examples of companies that have reduced their total share count by 50%. Over 2 decades, by 60%, 70%. The first example I have for you is AutoZone. The ticker symbol is AZO. And this stock has outperformed the S&P 500. This is since 2004. Okay. And you see in green the stock price of AutoZone. This is a car dealership. This is a business in the US. And you have in blue the S&P 500. So compared to the S&P 500, a basic ETF, outperformance. Okay. And okay, the next slide I want to share with you is NVR. Same thing. This is a buyback king. This is a cannibal. They eat themselves. They eat their own shares every year. And this is a home builder in the US. This is a boring industry. Still, over the past 20 years, it has outperformed the S&P 500. Now, I have another example with FICO, Fair Isaac. They generate scores for loans in the US. A boring business, but it works. It works, and every year they do buybacks. They repurchase their own shares. So in green, you have a strong outperformance compared to the blue line of the S&P 500 over 20 years. And I believe that this strategy will continue to work in the future. Warren Buffett loves buybacks, loves when companies do this. And this is one of the reasons he is so rich, he is so successful with his investments, because you know what? His big hit was Apple. So one of his best investment in dollars terms. It's a big investment. And what does Apple do? A lot of buybacks. They have bought back a lot of shares for the past decade. And so, yeah, this is a common characteristic of investments that outperform. Okay, so how do buybacks work? You start with AutoZone. So I will talk about 3 examples. The first one is AutoZone, AZO. You see over the past 20 years, so since 2004, they have bought back 78% of the total amount of shares. So they have bought back 80% of their shares. And on average, the CAGR, the compound annual growth rate, has been 7%. So every year, they buy back 7% of their shares. 7%, 7%, 7%. And you know what? Management is smart about it. If the stock price drops for some reason, there is a crash, they buy even more shares. They take advantage of the cheap valuation to buy more shares. So that's a very smart way to allocate capital. And so over 20 years, they have bought back 80% of the shares. That's enormous. So for the remaining 20%, it has an impact on EPS, earnings per share. You see in green here, the earnings per share of AutoZone over the past 20 years. I don't know where to put my face actually. You see that EPS, diluted earnings per share, have grown 17% per year for 20 years. Nice expansion of the earnings per share. And over the long term, the stock price follows the earnings per share. So what you see, the next slide, is over the years, if you had invested like 20 years ago in AutoZone, you would have had a performance of 20% annually with a boring business. A big car dealership business in the US. So that's very boring, and that works because every year the company generates cash flow. With the cash flow, they do buybacks. That reduces the total number of shares. So for the formula earnings per share, you have the earnings divided by the total number of shares. So if you reduce your total number of shares, EPS grows, and because EPS grow, the stock price grows. And it has worked for 2 decades and even more. And I believe their strategy is very clear. By the way, if you want to check for AutoZone, they will continue to do this in the future. And I believe for the next decade, they will continue to do buybacks. They will continue to boost their earnings per share, and they will continue to have their stock price that will go up. That's my opinion, and I'm a shareholder of AutoZone for this key reason. Management has understood something about capital allocation. It can create value for shareholders in the long term. You don't need a big innovation, a big reinvestment rate. You don't need to change the world. Just create value for your shareholders. Management has understood this. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of this video. Now let's talk about NVR, the big home builder in the US. They have bought back, 60% of their shares over 20 years. So since 2004, including the great financial crisis that impacted home builders in a large way. So you see here, they stopped buybacks to survive, to do something else with their cash, and then resumed. So even during this big crash, they did some buybacks here and there actually. So yeah, that's a very smart way to allocate capital. And over the years, on average, they have bought back 4% of their shares over 20 years. And if you take this short period after the great financial crisis, you will have a CAGR which is bigger than this. So maybe they have bought 6%, 7% of their shares annually, consistently. And look at the earnings per share. You see, this is the great financial crisis. This was a real estate, home builder industry. So it's a big hit. And even including this big hit, EPS has grown 11%. EPS has grown 11% over 20 years, which is more than the average S&P 500 business, more than the average American business, even including the great financial crisis. So it's a zero for almost a decade. This is phenomenal. And you see the stock price here, even including the great financial crisis, stock price growth of 14% for 20 years. And I'm sure that if you reduce the period after the great financial crisis, you just take the period after 2009, for example, the CAGR is way better. It's 16, 17, 18, 19, 20% per year. So it works, even for difficult industries, because management has understood something about buybacks. And the next example is FICO, Fair Isaac, simple business model. They create scores for loans in the US. This is a software business that has been here for decades and decades. And since 2004, they have bought back 70% of their total number of shares. Even during the great financial crisis, even during the COVID, they don't care. They just do buybacks. They use the excess cash not for reinvestments, not to pay off debt, not to do dividends, but to do buybacks. And actually, for FICO, they stopped doing dividends in 2016-17, something like this, to say we are only going to do buybacks now. We stop dividends completely because as a shareholder, you pay a tax on dividends. So we don't want this. It's more simple. Just do buyback for long-term value creation. So on average, they have bought back 6% of their shares every year for the past 20 years. And you see, this is EPS, earnings per share, going up 15% per year for 20 years, including the stagnation of the great financial crisis that impacted the loan industry, so the score industry. And you have this is the stock price, plus 23% annually for the past 20 years. And I believe that this strategy will continue to work because this business continues to do some buybacks. And now you are going to ask me, okay, Chris, that's fine, but how do you find these opportunities? That's very simple. You have a link in the description for FinChat. This is a promo code. This is a discount. The main screener I use in FinChat is FinChat to find these opportunities, these buyback kings. The 3 simple criteria I use to find these opportunities is 1, you want to have a diluted earnings per share. How can I zoom in? Diluted earnings per share, the CAGR is 15% per year for over 10 years. So you want something that has worked in the past. Now you want to see the share outstanding. You want to see the growth of the total amount of shares. Because you don't want to see growth, you want to see a reduction, so you have to put a minus. So I put between minus 50% and minus 5%. It works. So just put the same criteria and you will find these exact opportunities. So you want share reduction of minimum 5% every year for the past 10 years. And you want to buy them at a reasonable price. So let's say a price to free cash flow between 5 and 30. That's a good buying opportunity, a buying price for these businesses. You don't want to overpay for these stocks. And you see, I have 29 results from this simple screener. These are all buyback kings candidates. So okay, let's start the first one. You have Lowe's company that have generated some good results. EPS is growing 18% per year, 5% buyback for the past 10 years, and price to free cash flow of 21. That's a candidate. You have AutoZone that is here. We studied AutoZone just before. Here they have grown EPS 17% for the past 10 years, minus 6% of shares, and this is a price to free cash flow of 27. You have Toll Brothers, also a famous home builder in the US. Same thing, Murphy USA, and you have plenty of candidates for buyback kings. So the formula is really simple. If you want a strategy that consistently outperforms the market, look at buybacks. Look at companies that have bought back their own shares for the past decade, for the past 2 decades, because it works. And if management is smart about it, if management has a clear vision, it will work. And one last thing before I leave you for today is something really important, something major. All of these businesses have stable operations. You don't want to invest in a very cyclical business with unstable operations, with a lot of disruption. The best scenario for this kind of investment opportunities is when, 1, the operations generate a lot of cash flow. So you want the best scenario would be asset-light business model. Okay. 2, stable operations. So you don't want disruptions. You want something that worked in the past. I mean, AutoZone, this is a car dealership. Auto parts, insurance. This is not very volatile. So stable efficiency, stable margins. So you want stable cash flow every year that is working. 3, you don't want much competition. You want a moat, a competitive advantage, so that it adds regularity, it adds stability to your cash flow generation. So now that you have these 3 levers to have consistent, stable free cash flow, 4 is a management that understands the buyback process, sorry, the buybacks that create value for the long term. So you need these 4 key elements, and once you find them, you buy them at a good price and you hold for dear life. That's my advice. If you focus only on these companies, buybacks kings, you will generate a lot of wealth in the stock market for the next decades. If you like this content, I have an investing coaching program to make you a better investor. In this coaching program, you will learn a complete investing process. You will learn how to find stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. So what comes with the coaching program? You will get access to an exclusive community of like-minded investors, and you will get my personal guidance to help you build the portfolio of your dream so that you can have long-term results with your stock portfolio. Click the first link in the description to get more information. You will get a 10-minute video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.